Alright, what's going on, everybody? Hope you all are having a great day. If you're listening to this, you are the master of your reality. I am the master of my reality. And in today's video, we are going to explore the idea that the top is already in for Bitcoin. Is the top already in for Bitcoin? And so, if you have watched my previous videos explaining this diminishing rate of return of 5.3 for Bitcoin, you remember this chart right here. And I haven't changed anything in this chart. According to this 5.3 rule, a prediction of 77,000 at the low end to around 90,000 at the high end. And I may have been a little generous to Bitcoin with this 77,000 prediction. As you can see, the current all-time high for Bitcoin is right under 74,000 at 73,805, according to this chart. This is just the Bitcoin US dollar crypto chart here on TradingView. And so I may have been a little too generous, and I'll explain why. Alright, and so remember with the 5.3 rule, it's not exactly perfect on the number of what the actual gains are, right? So you can see here, the first cycle we had a 319,000% gain, Bitcoin did, and then you divide that by 5.3 and you get 60,188. Well, the next cycle's gains were actually 62,312. So a little bit more. There's a 3.529% discrepancy between these two numbers. Alright, and the average discrepancy from these three cycles is 5%, about 5%. Well, we won't have to do the math for all the other cycles. You can figure it out by looking at this chart. You divide the previous cycle's gains by 5.3, and that gives you almost perfectly the percentage gains for the next cycle. So we take the previous cycle's gains from 2018 to 2021. All right, and Bitcoin did 2,000%, 2,108% from its all-time low, 3,124, to its all-time high at 69,000. All right, so that was a 2,108% gain. You divide that by 5.3, gives you 398. All right, so that was where I got this 77,000. I didn't factor in any discrepancy to the downside, which I should have done. But Bitcoin's current gains for this cycle is already at 376%, from all-time low around 15,000 to its current all-time high at 73, almost 74,000. That's 376%. That's a 5.8, what does that say? 5.85% discrepancy between these two numbers. All right, that's well within our range. As you see, between the third cycle and the fourth cycle, there was an 8.49% discrepancy. So 5.85 is well within the acceptable range for this 5.3 rule to remain valid. That's the reason why I say, could the top be in for Bitcoin right now? And we're going to explore that idea and get a little deeper into how this could all actually play out if this is the top of Bitcoin. And as you can see here, from where our current all-time high is, where the 5.3 rule projected us to, is only a less than 5% difference, 4.45%, from 73, almost 74,000 to 77,000, where it originally predicted it to go. All right, and I don't think I've touched on this, but I always wondered why the number was 5.3. Why is it 5.3? And I think I have figured that out. All right, if we look here, this is a Fibonacci spiral. All right, this is where you get the golden ratio from phi, what is it, 1.618, I think. You have pi 3.14, and then you have phi. This ratio is phi. This is expanding at 1.618. But these quadrants in here, you can assign numbers to them. And so this would be 5, this one would be 3, and there's your 5.3 right there. And it makes sense that this is the diminishing rate of return of Bitcoin, because if you think about this spiral as how energy in this universe works, as you go out of this spiral, you're expanding. This is expansion, all right? As you go inwards to the spiral, you are contracting. This is contraction. Everything has an inflow and an outflow, expansion and contraction, all right? And Bitcoin has been expanding as far as it can go, and but the diminishing rate of return is contracting at a rate of 5.3. The charts show this. There is no denying this. Okay, this is a rule that has been in play since the inception of Bitcoin, since 2009. And so it makes sense why it's 5.3, because you can think of this as 5, and then this lower, I guess, quadrant, what separates these two being the point, 5.3. So it makes perfect sense. This is just the natural market emotions of humans, right? And this Fibonacci sequence shows up all throughout nature. All right, so that's why it makes perfect sense here. All right, so make sure you're following me over on X at Master Your Reality, spelled like you're texting. Master Your Reality, spelled this way, so you can stay up to date when I post cool stuff. Check out the highlights section under here. I have some of these little cool little snippets, little videos that I've made. This one's pretty cool. But anyway, so yes. All right, so these numbers are not making sense, right? For Bitcoin going to 100K plus, right? All these talking heads on mainstream media, and it seems like the people that I talk to that are invested in Bitcoin are certain that it is going to $100,000 and beyond. Whatever's popular is usually wrong, right? The herd gets led to the slaughterhouse. Now, just for fun, all right, just for fun, if we look at this right here, okay, if Bitcoin's rate of return is contracting at a rate of 5.3, because Bitcoin is essentially a bubble, its price action is 100% driven by speculation, because Bitcoin has no utility. So, getting back to this idea here though, if Bitcoin will be eventually seen as a failed blockchain because of its lack of utility, then what can we expect from a successful blockchain that has real utility, that works as payments? You can tokenize things on it. And so I got this idea of 5.8 as a rate of expansion. All right, this is just totally theoretical and me just having fun with this 5.3 rule. All right, so let's say that XRP actually becomes extremely successful. Could we see a rate of expansion instead of diminishing returns, exponential returns at a rate of 5.3? All right, keep in mind that XRP equals 58 in Gematria. Pretty interesting. And so I did this math, right? You take the all-time low. XRP's only had one really big move up, so that's why it's we can't prove this yet until it has its next big move up, probably this year. But you take from the all-time low to the all-time high, and that was 117,942%. Multiply that, instead of dividing it, because we're talking about expansion now, not contraction. You multiply that by 5.8 and you get 684,063. All right, and that gives us, if XRP was to do from its all-time low around 11 cents to whatever price, that would give us 684,000%, that would give us a price of $779 per XRP. All right, I think that's possible. Is it pretty far out there? Yeah, but it's possible when you factor in the big picture, right, of what XRP is and what it was built to be, and if it is successful and people make the realization of what it is, a number in the high hundreds of dollars is very possible for XRP. All right, so just keep that number in mind as we move forward through this year and next year, and beyond. Obviously, that'd be very extreme for this to be achieved in, by even 2025. But just keep that in mind. So this is why the top could already be in for Bitcoin. All right, it's already hit the range of acceptable targets for this 5.3 rule. And so now let's look at some of the other economic indicators, kind of just an overview of what's happening right now to kind of see where we're at in this story. All right, and so I'm going to actually start off with some bank stocks here. All right, so first we're going to take a look at JP Morgan here. And that is up almost 100% from its lows back in 22. And it's had a really nice rally, especially from October, that solar eclipse in October that we had. It's just really gone on a rampage. And recently we've had a big pullback. And the idea that I'm going to get at here, going over all these indices and stocks and whatnot, is could we be in the beginning stages of a debt collapse, basically? All right, and so let's compare this with Bank of America. All right, Bank of America did also have a pretty substantial correction recently. However, it's already recovered. It's recovered a lot stronger than JP Morgan. Now, also keep in mind, while Bank of America has not yet made new all-time highs since 2022, JP Morgan has. And so there's not a whole lot here for me to talk about with these two, but just I think it'll be interesting to look at these two stocks, Bank of America and JP Morgan, as time goes on, because one, as we know in the XRP community, Bank of America has XRP in their patents, right? And so they obviously know what's going on, while JP Morgan, we know, was they've been involved in Ethereum since the early days. And there's even like a clip of Brad Garlinghouse saying that some JP Morgan executives showed up at the Ripple HQ, and we're not sure what they talked about, but they were probably like, hey, give us a deal on some XRP, and Ripple had to turn down, most likely. That's what I would guess. But so it'll just be interesting to see, JPM versus BAC as time goes on, which one does better. But anyway, let's look at the Dow Jones. Dow Jones also went on a crazy rampage and has now had a substantial pullback. Could it be the start of a correction, down to this emerald zone, this inverse fib I pulled here? This is where things typically gravitate to. If it's a bearish fib, right? This 0.618 to 0.786, and this is again this Fibonacci sequence, these golden ratios here coming into play. Pretty much same thing on the S&P, right? Massive run up from October, and then we're having in the midst of what seems to be a correction. The question is, how far will this go? All right, the XHB Home Builders ETF. All right, I'll show you all a video here in just a second of what's going on in the real estate market. As you know, if you've watched The Big Short movie, after 2008, all right, after the all these very poorly backed mortgage-backed securities that were backed by a bunch of like shady mortgages, that people that weren't paying their mortgages, basically anyone could go and get a loan on their mortgage. And when people weren't able to pay, this whole Jenga tower collapsed, just like in the movie. And they didn't stop that. The same things have gone on since then. So it is rational to assume that real estate is is also in a bubble, propped up by this easy money borrowing. And so it'll be interesting to see what happens to this ETF. It's a good 35% correction there to the middle of that emerald zone. All right, and let's take a look here at some developments that are going on, some ghost developments in Austin.
Hey guys, just a quick hello here. You will not believe what we just found. This place is completely deserted. These were new build sites in Austin. They're being advertised as mid-city office and home. But look at this. Look at these windows. This is unbelievable. Wow.
Well, yeah, so this was really posted on April 15th. So this is recent, okay? You have these developments that a builder, says, all right, I'm going to build this stuff, and then they just bail because who knows what. But this is not a good sign of strength for the real estate market. All right, let's check out the VIX, the volatility index. We're having some kind of a little spike here, seems to be. So volatility in the markets is increasing. And if we zoom out a little bit, I've marked in the past, let's go to the 2-week chart. You can see in the past, this is how high this thing's gotten. So here is your dot-com bubble crash in 2001 and 02. And then we have our 08 housing bubble. And then right here we have Convid. So these are just like kind of arranged to track to see, how much volatility, how crazy is this thing gonna really get. It almost seems like we got some kind of trend line here. Maybe something like that. So keep an eye on this. Just another indicator that we can kind of gauge what's going on. All right, let's go to the dollar. We go back to the daily chart here. Now, the dollar, all right, as you know, I'm sure you know, as things sell off, this goes up. The dollar, the DXY goes up as, stocks and crypto sell off. That's how this typically works, right? Because people are selling into dollars. The dollar is like the cleanest dirty laundry is how a lot of people refer to it, right? It's a fiat currency backed by nothing, but it's the best, it's the most accepted one, so that's the one most people use. Entertaining this idea that we are in some kind of collapse right now, the beginning phases. What this thing could likely do is gravitate up here to this emerald zone, around 110. And then after that, if this escalates into a currency crisis, the dollar collapsing in value, mass sell-off of dollars, well, then this thing could just run up to this emerald zone and then absolutely tank. I think that's how that works. All right, keep in mind, guys, I'm not like an expert. I'm just doing my best to share with you my research and try to paint the best picture that I can paint. All right, here's the 10-year yield. All right, you can see since 2020, this thing has been going up quite a bit. So you can see it's interesting. The bond market knew about Convid being declared, the global event before the event even really was declared that, we can see this mass sell-off. So bonds work like, this is the yield chart. This is not the price of the bonds. You can see it's at like 4.6%. So the way bonds work is as the price of the bonds go up, the yield you can earn from holding them goes down. And as the price of bonds go down, this yield here goes up. And so what we can see here since 2020, all right, this yield has gone up significantly. Let's measure this. All right, so since this low here, and not even that wick there, but this low here, this thing's up 800%. All right, and so what this is telling me is that people are not very optimistic on the U.S. economy in 10 years from now. That's what this tells me, okay? Because if there's a lot of demand for this 10-year bond, you're basically saying that you believe the U.S. is going to do good over the next 10 years. But since this yield has been going up and up and up, the price of these bonds has been going down. That's because there's a lack of demand for them. That tells me there's a more pessimistic than optimistic view for the U.S. over the next 10 years. And I actually asked Grok, this XAI, if my thinking here was true. I said, so let me get this right. As bonds sell off, making the price of the bond go down, the yield you can earn from them goes up. He said, yeah, that's correct. When bonds are sold off, the prices decrease. However, the yield, which represents the return an investor earns on a bond, increases. The reason for this relationship is that when a bond's price decreases, its yield increases to compensate for the. Okay, yeah. So I said, so then, would it be fair to say that since the 10-year yield, the yield on the 10-year treasuries has gone up significantly over the past 4 years, this means people are selling these bonds? And you could say that this means people are not optimistic on the outlook of the U.S. 10 years from now. And Grok said it would be fair to say that the increase in the yield on the 10-year treasuries over the past 4 years, particularly with the yield reaching 4.63% by April 2024 this year, as per historical data, indicates that there has been selling pressure on these bonds. This selling pressure could indeed be interpreted as a sign of less optimism about the outlook on the U.S. economy over the next 10 years. All right, and then he just goes on to explain, and then he says, in summary, while the increase in the 10-year treasury yields could be seen as a sign of less optimism, it's just one piece to a larger economic puzzle. I 100% agree with that. It's always a good idea to look at a variety of economic indicators to get a comprehensive understanding of the economic outlook. And that's exactly what we're doing in this video. We're not just looking at the 10-year yield. We're looking at a whole bunch of stuff. Real estate, the dollar, And so even this Gregory Mannarino, and shout out to Gregory Mannarino, man. That guy is a G. But the Mannarino market risk indicator, right? This combines the dollar index Dixie and the 10-year yield he made this indicator to kind of show market risk. Basically, as both of these things are going up, right? The dollar, because people are selling and going into dollars, and then this bond yield, as the bond yield goes up, that means people are selling these bonds, then this risk indicator rises. And so just recently we crossed back into this extreme risk zone. You can see here you have low risk, moderate risk, high risk, and extreme risk is above 300. And so we just crossed back into that. I think the all-time high for this indicator is around 329. All right. So keep an eye on this indicator, guys. You can find this at traderschoice.net. I'll put a link to this in the description. Shout out to Greg. All right, now, what else we are seeing? This was posted today. All right, so you guys are getting this fresh off the press. Breaking credit card delinquency rates at Discover Financial, the 6th largest credit card issuer in America, just spiked to 2008 levels, according to Reventure. At Discover, credit card delinquency rates in Q1 2024 jumped from 4.7 to 5.7 in 2024. Okay, yeah, no, that is right. So in just in the same quarter, it's already jumped up a whole percent. To put this into perspective, delinquency rates going into 2022, just 2 years ago, were just at 1.5%. This means that delinquency rates are nearly 4 times higher than they were just 2 years ago. Americans are still spending at record levels even as savings have been depleted. Are we in a credit card debt bubble? We are in an everything bubble. Okay? So here's this chart here. You can just see this was the 2008 right? And we went all the way up to 9%, and here we are again, starting this parabolic run of credit card defaults. All right, so that's just another economic indicator that we might be approaching chaotic times. All right, and what is this everything bubble, right? We're not just in a credit card debt bubble, we're in a stock market bubble, a Bitcoin bubble, in my opinion, real estate bubble. And so let's talk about this everything bubble. All right, and this is caused by this right here, all this money printing, right? The Fed has essentially created a bubble by printing all this money. And there's more to that, obviously, but this is something we can look at to point at and say, oh, that's a problem. And you can see here this massive, massive increase in the M1 money supply. And this was due to the events of, March 15, 2020, COVID. They printed all this money because effectively the entire world shut down, right? The economy, supply chain, all this stuff just came to a halt. And so to prevent the full-on collapse, prematurely before they are ready, whoever you want to think of as they, to prevent that, they printed all this stimulus money to keep the economy afloat. Today, our economy's propped up on this funny money on stilts. Now, another thing to take into consideration that will help us get a better understanding of how this could all play out, because obviously this is unsustainable. Now, the same time that they did this, they printed all this money, they changed a critical piece of how our economy, our financial institutions operate. And what they did is they changed the reserve requirements, the minimum reserve requirements. I'm sure you know that we operate in a fractional reserve system. So that means our financial institutions, our banks, are only required to hold a fraction of deposits at any given time, right? And they take the rest and they lend it out. That's how they make money off the interest, okay? So it used to be 10%. That was the reserve requirement before March 15th, 2020. But after March 15, 2020, you can see this is from the Fed's website. As announced on March 15, 2020, the board reduced reserve requirement ratios to 0%. 0%. Not 5, not 2, 0%. Effective March 26, 2020. This action eliminated reserve requirements for all depository institutions. That's your banks. Okay? So that means that they don't have to hold a dime, a penny of your money. They can lend it out and put it in the market, whatever they want to do with it. They don't have to hold a dime. So the banks don't have your money. So that means if there were bank runs, if there was panic, you would not be able to get your money from the bank. All right, this is the situation that we are dealing with. This is the absolute insanity of our current situation. All right, now, and then I'm sure that we remember this Silicon Valley Bank collapse, March 10th, 2023. It started to happen early. We had a bank collapse. And I won't dive into why this happened, but there was a bank run, unsuspected. And so, everyone who lost money in this was made whole, but, they just printed more money. But what they did here, and this is the important part, they just created a system to prevent more bank collapses from happening. All right, they created, again, from the Fed's website, Federal Reserve Board announces it will make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors. What does that mean? Well, they created this program to make sure that more banks don't collapse like Silicon Valley. Basically to look at, all right, which banks are close to collapse. All right, we're going to give you all some money to make sure you don't. Essentially, that's what this program was. This was called the Bank Term Funding Program, and that was created on March 12th, 2023, 2 days after Silicon Valley Bank collapsed. On January 24th, they announced that it will be ending on March 11th of this year. And it has ended, right? This is over. This bank term funding program, the program that was created to make sure no more banks collapse, is no longer in operation. All right, so more bank collapses are on the table. That's what that means, that it's in the cards. All right, so obviously we're in an everything bubble, right? Money's been easy to borrow, technology is advancing and creating stimulus in the economy, AI, right? AI stocks have gone crazy, speculation is at an all-time high, Americans are spending at an all-time high and borrowing at an all-time high. So we are in a bubble, an everything bubble, and eventually it's going to have to collapse. And so I'm going to do my best, based on all the research I've done, to explain what I envision the everything bubble bursting to be like. All right, and this is really the perfect storm of events for this all to happen. So we're actually going to start out in 1944 with Bretton Woods. This is when the US dollar was established as the world reserve currency after World War II. And so this gave incentives for other nations to trade in dollars. And the incentives were a gold standard, that US dollars were redeemable for gold or silver. It gave the countries who agreed to this US protection and easy borrowing. All right, so these were the incentives. This is why it actually made sense back then to adopt the US dollar as world reserve currency. All right, but along the way, we made irresponsible monetary policies, with the US being the leader in 1971 when we, we ended the gold standard. We took the dollar, we depegged it from gold, and then we created this petrodollar, which was just essentially an agreement between the oil producing nations to do all oil trade in dollars. And so this was signed by Nixon in 1971, and then after that, pretty much all other nations abandoned their gold standards as well, and their central banks created fiat currencies. And so that's why I love the market snipers quote that we're in a leper colony, and the U.S. is like the king leper. Um, anyway, that's pretty funny. But and so we had extreme money printing, since 1971. Oh, and then I asked Grok here, what percentage of value has the U.S. dollar lost since 1971? The U.S. dollar has experienced a significant decrease in value since 1971, losing approximately 87% of its purchasing power over the years. This means that $100 in 1971 would be equivalent to about $771 today. That is crazy. 87% down is the dollar. All right, but let's continue. So, in 2001, the dot-com bubble, 2008, and 2020 are just simply bumps in the road for the Fed. They have to keep this system going. They can't allow a full-blown collapse of the system, Great Depression 2.0. They have to keep it going. That means more money printing. All right, so these events, these big events throughout the years are just, bumps in the road to a new system, which is inevitable, which they all know. And so they're preparing for that new system, but they're only going to allow it to reveal itself when the time is right, when they're essentially forced to make that switch. And so, we've had this irresponsible monetary policies. And so now, instead of there being incentives for other nations to trade in dollars, there are now incentives for other nations to trade in other currencies other than the dollars. Mainly an escape from the devaluing currency and escaping from US sanctions, right? The SWIFT system is like controlled by the US. They can just turn it off on your country if they don't like what you're doing, and so obviously if you're another country, you don't want to have anyone have the ability to just completely turn off your trade, right? So that's the main incentives. And this goes for everyone, right? The U.S. is also escaping their own devaluing currency, a new national currency backed by assets. That this is a big incentive for all countries to get off this U.S. dollar fiat standard, right? To go back to currency that is real, backed by tangible assets, mainly commodities, probably gold and silver, right? And then the big one now, we have technological advancements, mainly blockchain. All right. This allows for neutral bridge currencies that no one can control, like XRP, XLM, XDC, etc. Any cryptocurrency could theoretically serve as a neutral bridge currency. The question is, which ones are they going to actually use? All right, and so I think XRP and XLM will be the two most used, most widely adopted for cross-border payments. Right, that's their specialty, payments. I think XDC is good at payments too, but I'd see these two really thriving. One for the banks and the governments, and one for the people. One backed by gold, one backed by silver. The result of this, what this all looks like, once we transition off the current system, is we transition from a unipolar currency world dominated by the US dollar. That's the one pole we're talking about here, to a multipolar world, a multipolar currency world. You'll have many different countries' currencies being accepted in trade, because this distributed ledger technology is allowing the receiver of one currency to receive whatever currency that they like, using this cryptocurrency DLT. So distributed ledger technology currencies, crypto, that end up being adopted become some of the most valuable assets in the world, because they're going to be the assets that facilitate this multipolar currency to work even better than this unipolar currency world. All right, so that's the big picture. All right, now let's zoom in a little bit on what this transition could really look like. All right, it has to first start out with them building this digital infrastructure. Nothing's going to work if we transition to this multipolar currency world with no distributed ledger technology system to facilitate trade. Everything's going to collapse. So we need this system, the digital blockchain based system, to be ready by the time that we're ready to make the switch off the dollar. All right, and that is what the ISO 222 standard, the ISO TC 307 standard is. This is like Q&T's own standard, right? You have this is what the majority of ISO 222 coins are certified with. This is like the currency standard, and this is like the interoperability standard to make sure everything actually is interoperable and can talk with each other. That's Q&T. All right. So once and it's already built, right? It's ready to go. Then countries will agree to trade oil in currencies other than the US dollar. And this is already happening. All right, you got the BRICS nations joining forces to not separate, but just agree to come together to kind of stand up to the U.S. and say, look, we're done with your system that is at the brink of collapse, and we're going to create our own system to do trade in. All right, that's what's already happening. All right, and then because of this, because this, obviously the US isn't happy about that, even though they might be. Who knows, like there's layers to this stuff, guys. I'm not gonna try to explain the intentions of everyone, but but regardless, this action, other by these countries agreeing to do trade other than the US, that creates global conflict. So that's what we're seeing right now. And make no mistake, whatever we see on the world stage, conflict wise, it's all because of finance, right? It's all because of money. at the end of the day. It's not because of religion or whatever excuse they put on the news. It's about money. And we're in a transition from a new system, from an old system to a new system. And so there's going to be chaos. There's going to be conflict out of that. And so that's what we're seeing really start to escalate right now. And eventually, so that's where we are right now. And everything else below this right here is pretty much has not happened yet. But this is how I see it going. So just remember that this is for sure already happened, and then all of this right here is just kind of my best guess based on my research. All this, okay. So we have liquidity crisis and mass debt defaults. This will be your market crash and bank collapses. This is where a liquidity crisis is basically there's no one willing to lend money anymore. The liquidity dries up. And so if you're an operation, a business, whatever is dependent upon that liquidity, that funding, and that dries up, well then that's the end of the line for you. You go down. And so there's going to be, and that's the same for banks, for small businesses, for large businesses. Once that liquidity runs out, the infrastructure of our economy begins to collapse. All right, and then you see mass debt defaults. That's kind of what we're seeing right now with these credit card defaults rising, right? All right, and then once this happens, I think the next step would be other countries, they dump US dollars. And keep in mind, guys, because the US dollar is the world reserve currency, other countries hold dollars. Most dollars are held overseas. All right, they're held in these nostro vostro accounts to allow them to do trade. All right, and they'll sell off US treasuries, the bonds. So watch Japan, because Japan holds a ton of US treasuries. They hold more US treasuries than their own. And simultaneously, when this happens, that money is going to flood into commodities. Precious metals, energy, real estate, and yes, cryptocurrency. Cryptocurrency is a commodity. They're digital assets that have the good ones have a fixed value, right? A limited supply, just like these things. So it is possible, actually, that stage 4 and 5 happen simultaneously, that we get a liquidity crisis, we get the collapse combined with this flood of money into commodities. All right, and so if that were to happen, the commodity crash would not be as bad as the debt market crash. Now, what is the debt market? Well, you got pure debt, which is mainly just bonds, T-bill, treasury bills, the US dollar, and Tether. So that would obviously implicate crypto. And then you have assets that are simply inflated with debt, but are not debt themselves. You got stocks, you got real estate, super inflated with debt. Certain businesses are just surviving on debt. And then you have crypto, and I think crypto will suffer the least, especially since certain cryptocurrencies are literally what make up the new system. So as money flows out of the old system and into the new system, crypto's not gonna crash as much. We could see like a very quick liquidation, and then we could just pump, to the freaking moon after that. Now, after this all happens, after essentially the collapse happens, they got to blame someone, right? So it's possible that central banks are dissolved by the government. That's possible. That's an optimistic viewpoint, but it is possible. And then you'll see cryptocurrency regulation passed in the US, right? It's mainly already done in other countries, but finally in the US we'll have clear rules of the road and guidelines for crypto. And then you'll see a debt restructuring, all right? They have to, the old system is collapsed, so they got to make a new one, and we're going to go back to the gold standard. There has to be something backing our money. And so in order to account for all the money that we did create, all the printing, it's likely that that the gold backing our new currency is going to be at a much higher value. And so that's where you get this idea of gold revaluation, which is basically just governments coming together and say, hey, we agree that gold is now this price. and then boom, gold is now that price. So that's one of the reasons why I am investing in gold. Also, just not because of the possible revaluation, also because it is a, it's been money for thousands of years. It's a good store of value. Not financial advice, obviously. None of this is financial or investment advice. It's just for entertainment and educational purposes only. All right, and then after you have the collapse, you got the new rules of the road, you got the new system. Then the victims of the collapse will be made whole via an asset-backed digital currency available in a digital wallet that you'll have to get if you don't have one. And so I don't really think there's so much negative talk about the CBDCs, and especially if the central banks are dissolved, then there won't be any CBDCs. But I think it'll make more sense for there to be asset-backed digital currencies, ABDCs. I think that will be more accepted by the public, and and just kind of make more sense overall if we are going back to. So that's kind of how I see this all going. This is subject to change, obviously, as time goes on. I will adjust this and keep y'all updated. But with the state of the market, with what's going on right now, and where Bitcoin's at, I wanted to make this video just to give y'all a, kind of an update on that crypto, how to prepare for 2024 video that I made. And so this is why this picture is just so beautiful. So much truth to be shared in this picture, in this photo. And some people might be saying, "Oh, this is messed up, man. How can you be excited about, the collapse of the everything bubble? Like, so many people are going to be hurt by this and affected in a negative way by all this. How can you be excited?" I'm not excited for people to be hurt. 100% not. I wish that wasn't going to happen, but it is inevitable. I can either choose to mope around and feel bad for other people and hide my excitement for my future, which I'm extremely excited about, and I think everyone should be. And the fact is, guys, is that I and other people in XRP community land and crypto have done the research. All right, we put in the hours, we put in the work to prepare for what is coming. Most people aren't preparing at all, and those are the people who are going to get hurt by this, not us, not you guys watching this video, hopefully. So I thought this was funny to put in the video. Because it's so true. It's so true. It's like, bring it on, man. I'm ready. I've studied it. I'm prepared. I've done the work. I've made the sacrifices. Now let's go. Let's create generational wealth for us and those in our realities. And so I hope I ended this video on a positive note. There is so much to look forward to. We just gotta buckle down and get through this turbulent time, guys. And if you're just now getting into crypto, well, now is the time to take decisive and thoughtful action. Now is not the time to be waiting around for prices to go up, or for whatever, for whoever to tell you now's the time to buy. Because when the media tells you now's the time to buy, it's going to be close to the top, and chances are, it won't end up being profitable for you. So that's why it's important to be ahead of the curve, to take accountability for your actions now, and become the master of your reality, guys. That's what this is all about. The wealth that we will create for ourselves through this the biggest financial transition in human history will be insane. It will be historical. And generational wealth will be made, not through Bitcoin. All right, so let's keep an eye on the Bitcoin chart. Let's keep an eye on the market, guys. We are in the final moments, it seems like. So hang in there. Dollar cost average in, Have a plan, have an exit strategy, and you will win. You will be prosperous and successful through the Great Reset, through this, whatever, Nasara, Jasara, uh, whatever this is, this transition, you will be prosperous if you do these things. So that's it for this video, guys. I really appreciate you watching till the end. Thank you so much for your support. It means the world to me. I'm glad we got some people signing up to the free Discord, which will be free until we hit 1,000 subscribers. So click the link in the description to join the private Master Your Reality Discord if you are seeking guidance on your journey of self-mastery. And leave a like on this video, please. Helps the channel out. And share this video with anyone who you think will benefit from it. And comment down below. Let me know what you guys think. Share your thoughts. I love hearing your thoughts and responding to your comments. And that's it, guys. So thank you so much for watching. I wish every single one of you much love and abundance. And until next time, master your reality.